It's that fear of missing out, right? And that's why they do it. But yeah, if you're doing investing, then you never should bet on appreciation, right? To determine whether you buy or not. And it's just the cherry on top. Like, yes, you'll probably get it, but don't expect it.
Welcome to Agent Success Podcast. If you're a real estate agent looking to succeed in today's crazy market, well, you're in the right place. Each week, we talk with successful real estate agents willing to share their expert insights, trade secrets, and mindset that help them to succeed. There's no fluff, just straight to the point content that prioritizes one thing above all, your success. So without further ado, let's cut to the chase.
Welcome to another episode of AgentSuccessPodcast.com, where we dive directly into how to win in real estate without all the silly fluff. Today, I have with me a friend of mine, a fellow loan officer, Mr. Ryan Jahnke. How are you, Ryan?
I'm having a great day, Tim.
Well, that's good. It's better than not having a great day. And one thing that Ryan does is he kind of, I don't want to say masters, but specializes, does a really good job in real estate investment and understanding how to leverage your money, understanding what to do with your money in real estate. And so we are here to pick his brain and find out.
I'm ready.
How does the average Joe invest and win when it comes to real estate investing, as opposed to I could put my money in my savings account, Ryan, I'll get 0.00001% interest over a 10-year period. Yeah, it's a good way to do it. And then the inflation will outpace your growth.
That's right.
So let's start with this. How long have you been investing in real estate? Like when did you buy your first place?
Yeah. So I bought my first rental property in 2009, which was actually a really good time to start buying.
Yeah, that's an excellent time.
Primary residence was at the end of 2006, so we could say that was real estate investing too.
Yeah, I guess so. I bought mine. It was at the end of 2006 as well. So when I bought that, looking back, hindsight, it was actually an awesome time to buy a house. But for about 15 years after that, you're like, that was a terrible.
I was in the same boat.
Yeah.
My house wasn't worth what I bought it for at least 6 years.
Yeah. Oh yeah. Exactly. And then I had people tell me at different times, oh, geez, you sell it, or I'm like, sell it and do what? Like, go buy another house, like. I gotta have a place to live.
Real estate fixes mistakes over time. That's one of the great things about it.
Oh, wow. I like that. Real estate fixes mistakes over time. That's the key, right?
Yeah.
It's like eating healthy. Fixes unhealthy behaviors over time. You gotta give yourself the right stuff. So you've been doing it for quite a while. You've would you say you've had more wins or more losses? Because I imagine when you do it, you got to have some losses, right?
Yeah. I mean, definitely more wins.
Okay.
I believe that you don't want to have an advisor who has no scars.
Ooh.
So I've definitely had some losses too. So I'll own that.
That's like if you have a stock investor that makes way less than you, doesn't invest very much of his own money, and he's trying to tell you exactly how to do it.
Exactly. Yeah. No dirty fingernails. That's not a good sign. Yeah.
Exactly. Well, it's like having a life insurance salesman that's never died. He doesn't know. He doesn't get it. I want you to live the life, man. So let's start with this. Why should I or anybody go invest in real estate?
Yeah. So let's start with some of the basics. There are 5 different ways that real estate makes you money, like if you have a rental property. So the first is called cash flow, right? Which is really just the difference between the money coming in every month in rent and your expenses on the property. So like, let's say your mortgage is $1,400. You have $200 that you want to set aside for future maintenance and things like that. So, but you can rent the property for $2,000, right? So, I mean, that would be a difference of $400, which would be your monthly cash flow. Okay, so that's simple, right? Makes sense. So the second way, and actually the most powerful thing over time, is called appreciation, right? That's when the value of the property goes up over time, due to the increase in the market. So Colorado Springs, we're thinking 3-4% a year on average over time.
Yeah,
and that's being conservative with it. That is significant money as it builds
Yeah.
each year to year, right? Over time.
Yeah. Oh, and that is a collective thing as well. So you may get 2% this year and 6% the following year, but you should be averaging that 3 to 4, 3 to 5, something like that.
So there's some growth, right?
Yeah.
And then the next way is called depreciation, which is really just a tax write-off. It's not a real loss, but what it does in essence is the money you make from that property and cash flow, usually is tax-free. Like you're not paying taxes on that because you get this tax write-off. And at the end, we'll talk about how that is so powerful for real estate agents in particular.
Specifically for real estate agents.
For people who are real estate professionals. There's some huge advantages to that.
Okay.
All right, so the next one, another big word called amortization, which basically means that each month that mortgage is paid, someone else is paying that, and that's building equity for you every month, right? Because a small portion of your payment goes to actually paying the debt down. And that increases over time. So as the loan gets paid down, that is money going into your pocket, right? That's your net worth. And the final way that most people don't even talk about, but I think is so powerful, is based on the time value of money.
Okay.
So like the simple way to explain that is that money in your pocket today is worth more than that same amount of money in your pocket 5-10 years from now, right?
Yeah.
Due to
if
inflation.
If I had $100 in 1920, I'm doing awesome.
You're doing awesome.
If I have $100 in 2020, it's like you got lunch covered and maybe
your teenager has a $100 bill in their wallet nowadays, right? Like it's not just the super rich guy.
Exactly.
So yeah, totally. So what's cool about real estate and mortgage is that your payment stays set for 30 years. But 10 years from now, that same $2,000 payment that I have is easier for me to make than it is
painful
right now.
It's less painful in 10 years.
Because like in reality, that's more like a $1,500 payment 10 years from now because the value
and we're talking
erodes.
Yeah, if we can build on that, and I want to hit a couple of points on all of these, if that's okay.
Yeah.
On the time value of money, are you basically saying, and this is I understand it's a basic concept that you learn in a basic economics class, but for the sake of just simplifying, are we just saying that inflation is like the speed of inflation adjusts the time value of money?
Oh yeah, definitely. So the higher the rate of inflation, the more powerful this time value of money goes.
Okay.
Because like you're paying back the loan with cheaper and cheaper dollars.
That's interesting. It's interesting nobody talks about that because it's a hard thing to conceptualize.
Right.
Meaning, I'm still paying $2,000.
Yeah.
Like it's still $2,000. and then if you go and you refinance, that amortization does reset. But maybe your payment is lower, which then maybe your cash flow is higher. So you have to it's almost like a Monopoly game or something. Like you're trying to, or a puzzle of some sort. You're trying to just maintain over time.
It's true.
Can I hit a few questions here?
Yeah.
So you mentioned cash flow. Would you ever look at buying a house that you knew was not going to cash flow?
Yeah, I mean, you really got to see how stable your other income is, right? Because you're basically, if you're doing that, you're guaranteeing that money's going to come out of your pocket every month.
If you have $200 going out every month.
Yeah. I mean, so if we talk 10 years down the road and you have very stable income, sure, I definitely would. Because if a $400,000 goes up, a $400,000 house goes up 3%, right? That's $12,000 in 1 year.
Yeah.
All right, I could make $12,000 by owning this home, and every month I'm losing $200.
Yeah.
I'm still going to make a whole lot more money over time.
Yeah.
And the other thing is that rents typically go up over time, right?
Yep.
But your mortgage payment doesn't. So that $200 will disappear over a period of 5 years or so. So yeah, but it's not you can't scale that, right? How many houses do you want to lose $200 a month?
So, well, and that's interesting because there was a book that I went through, Rich Dad Poor Dad, and this was 15, 20 years ago. It was a long time ago.
I mean, that's basically like the entry drug to real estate investing is that book.
This is the starter drug, kids. The first copy's free. Don't share it with your friends.
The gateway drug. Yeah,
exactly. So, but in that book, Robert Kiyosaki, and this is just something I remember from years and years and years ago. He's like, if it doesn't cash flow, then it's not like don't do it. But now I'm hearing what you're saying is there are 5 different elements we're looking at. Cash flow is one. It's like saying credit score dictates it. Everything on your loan. Well, that's a factor in qualifying.
Correct.
There's many other factors that go into that qualifying. So cash flow is a factor. An important factor credit score is an important factor, but it's a factor. And then we go down to appreciation. This is interesting. It's interesting because I feel like you can't really predict appreciation in the short term.
Absolutely, you're right.
But I feel like in the long term, like you said, 3 to 5% in a healthy area. I mean, if you're buying out in the middle of nowhere or a teeny little town that has no industry, that's a different story. But if you're we take where we live and we have a good population and a relatively good economy, and there's people constantly coming and leaving, and you can count on that appreciation. Now, obviously, sometimes it spikes and sometimes it doesn't. So appreciation to me would be a long game. Kind of approach.
I wouldn't depend upon it, as far as to make you purchase. But real estate's gone up in value 71 of the last 73 years. So I think it's worth betting on.
Well, and I'll tell you what's interesting though, just to jump into like a human psychology piece here. So when appreciation starts to go up and we see it, it's not right away that everybody jumps on the bandwagon, but everybody does jump on, not everybody, but a lot of people jump on the bandwagon, meaning, let's say early 2000s and we get really fast appreciation, right? And we see that happening for a year or two or 6 months or a year, and people all of a sudden, they're like betting the farm on appreciation. Like that's their whole bet is appreciation. But they're not looking at the other 4 factors that are on here. The time value of money means nothing to them because they want to flip this thing in 2 years. Well, you're buying a house hoping that appreciation continues. And then we saw this in 2021 where you have $50,000 appraisal gaps, and they're still trying to make up for that. Right? It's an interesting psychological flow that people get into. And
it's that fear of missing out, right? And that's why they do it. But if you're doing investing, then you never should bet on appreciation, right? To determine whether you buy or not. And it's just the cherry on top. Yes, you'll probably get it, but don't expect it. You're
not going to win the lottery or get rich off just the appreciation.
Right.
It's in the long run. And then you had depreciation. That's a whole nother one to unpack. It's like phantom losses.
Right?
Yeah,
it's paper losses. It's just saving you money on taxes, but it's not really money out of your pocket.
It didn't fall out of your wallet.
But
it does save you
so
money.
The general tax rules basically say that in 27 and a half years, you can write off the full value of the property. And that's just the most basic way to do it. But how many properties do you know of that are over 27 and a half years old and they're not worth nothing, right? Don't properties usually double, maybe triple? So that's the reality versus the tax.
If you bought 2006 and you're like, okay, this was a terrible time. I lost my skin for like 5 years, but now you're like, it's 3 times the value of what it was in 2006, 20 years later. Well, it's actually it's right at about the 20-year mark, so we're getting really close to what you're saying. And then the next one, amortization, which is interesting. If people don't understand amortization, look at amortization versus simple interest. You're paying an amortization schedule, and I really like the mixture of the person paying for your mortgage payment, but then combine that with number 5 of time value of money. And this is like alchemy. It's like this little, if you understand it, you know what I mean? It's like you have like 5 little elements that you're putting together. And if you can understand the right amount for each element, meaning what's your risk tolerance for cash flow? What's your reliability on appreciation? And if you can get a healthy balance between all of those, you've concocted a very
It's potent.
It's a very potent thing. All right, so that's interesting. Anything else you want to add on why somebody should? Because that's way more than I thought I'd get.
No. I think those are the great factors of why to do it.
Okay. So I have a couple now, and feel free to interrupt anytime. But I got a handful of just bullet points. That I want to go through. Can you compare for me what it looks like? So there's right downstairs. There's an investment group. I think there might be 2 in our building. I'm not sure. And they play the long game as well, right? And they tell you, well, you lost 20% this year, but don't worry, it'll come back. The stock market always returns. Maybe, I guess. I guess it always does. But the interesting thing about stock market to me is where is the money within the stock market? Your individual stock may not rebound, but the collective stock market is going to rebound. So can you just compare your mindset on I have $100,000. Am I going into real estate? Am I going into stocks? Like, what do I do?
Oh, I love doing this. Yeah.
Okay.
All right. So when you're buying a stock, you're buying a very small portion of a company, right? Essentially.
Like a mortgage-backed security. You get a piece of the mortgage.
Right. But you have no control. So the CEO could tank that company. The market could tank that company. You can do nothing about it, right? You're on the ride. You've also paid 100% cash for that stock. You know, if it costs $75 for a share, you paid $75 for that.
Yeah.
Right. Also, you usually choose, like, am I going to get a dividend stock where that's going to pay me returns, or do I want a growth stock? You know, very rarely do you get both, right? You're sort of choosing one or the other. So that's the basics of, in my mind, like, you're going to buy a stock or a mutual fund, something like that. All right. So I challenge anybody to go to their stockbroker and say, all right, I want a stock that gives me a consistent monthly dividend, that has a very strong potential for growth, that I can buy over fixed payments over 30 years. I want 100% control of this company. I want to buy the company, right? So I can do very real things to affect the value of this company. I want it to have great, consistent tax benefits. Oh, yeah, and one more thing. I want somebody else to make those payments for me over the next 30 years. That's not going to happen, right? Like, but that's real estate, right? I love it. So then let's take it to another example, right? All right, so you said $100,000.
Yeah.
If you have $100,000 in stocks, right? Unless you're trading on margin, which, I mean, unless you're an expert, you're crazy to do that, right?
Yeah.
So let's say for the average person, right? That's what we're doing this podcast for. All right, $100,000 of stock, it goes up 10%. You made $10,000, right?
Woohoo.
That is not bad by any means.
It's great.
But let's say you want the benefit of that, right? Because you get no benefit unless you sell it.
This is true.
Okay, so I got
again, it's almost perceived value, right? So the world perceives it's worth 10% more. I got my $10,000. Now the stock I own is worth $110,000.
Yeah. So then you sell, you know, the stock, right? Because you want your money out, or you know, you sell. Yeah, literally, you have to sell it. So then when you sell something, then you're paying taxes.
On
right?
the 10,000,
Yeah. So if you, depending on how long you held that, you know, it's either at capital gains rates or at normal income rates.
Yeah.
So it could be somewhere between 15% and 35% is like gone, right? So to sell it, you got to get the tax benefits, or you got to pay tax basically. So let's compare that to real estate. Same $100,000.
Okay.
But if you got $100,000 in real estate, you can buy a $400,000 property. Right? That's a 25% down payment.
That's an excellent down payment.
So if that property goes up 10%, you've made $40,000, not $10,000. Okay? There's area number one. Next, you don't have to sell the golden goose to get money from it, right?
Okay.
So there's a couple of things. One, hopefully you're getting monthly cash flow.
Yeah.
Yeah?
Yeah.
But if you want even more benefit, there's something called a cash out refinance. So you refinance the property, and I've done this to properties before. You know, let's say you take out $75,000.
Yeah.
Do you know that that's tax-free money because it's a loan? You're not paying any tax on that. All right? And if you do it in such a way where the rent you receive is still covering that mortgage, so again, you're not losing money on cash flow every month, like, you don't have to sell it to get the benefit, right?
You're not like all or nothing, get rid of the stock, give me my 10 grand, and then I'll pay taxes on it.
Exactly. So you maintain ownership, and you can hold it long term, and that property can continue to go up in value when you're getting benefit from that. So for me, it's like day and night.
Yeah.
I mean, I don't even think there's a decent comparison there.
I'm sure there's some stock guys out there who are like, I've made 20% every year for the last 100 years. And they'll say something crazy. But it's interesting to me to also think, like, I can leverage borrowed money with my cash to create more cash. Unless I'm shorting stocks, then then you're not borrowing the money to invest in stock, and if you are, then you're paying interest and hoping it goes up. And it's interesting also, as you're talking, you say, well, you don't control this company, right? The company, you have no control of the CEO. You don't have voting rights on it, nothing. They can do all kinds of stuff, make crazy trade deals, whereas a house, it's almost like the entire city, the whole population controls that, as far as, like I say, economic health and how clean the city is. All those things play into that. It's not one person that's going to crash your house value.
Right. So how often does a house value go down to zero? I mean, never, right?
Yeah.
Yeah. So, but then things you can control is, let's say you put in landscaping and increase the value, right? What if you add a bedroom or a bathroom? If you got extra land, you can put in a ADU and get another rental unit in there. It's like you can do very specific things to that property
to increase the value even further.
Force appreciation.
Well, almost like you were saying, it was kind of interesting. You said, okay, I'm going to invest, I'm going to put $100,000 of cash in on a $400,000 house. It's cash flowing a little bit. I'm going to pull, and let's say the appreciation went up. I got 40,
like let's talk 5 years.
Yeah, okay. Yeah. So I got $40,000. I'm going to cash out $75,000. You can take that $75,000 and you could do an ADU in the back of that same place.
Sure.
And then now you have.
Yeah, or just buy another property.
Buy another property, whatever it is, right? It's a way to not just, you're paying interest on it, but you're also making money on it.
Yeah.
You're basically repeated the cycle through the appreciation of the current house.
Yeah.
By pulling the cash out and doing it again.
Yeah. So if you do that, in a smart way where you're not losing money every month, then I love that thought of buying another property, right? And now you have several properties going up in value. So it's like that snowball that over time, it gains momentum,
bigger and bigger. Yeah. Let's talk about easy ways. Like what you're saying makes it sound easy. But have you ever seen like a professional skier or professional mountain biker? It looks so easy. I can easily jump that, right? And then you realize, it's really not that easy. They just have all the skill set to be able to accomplish that.
Right.
In your case, figure skating, right? You see somebody who does really good, you're like, I can do that. You're like, apparently I can't do 900 twists in the air, right?
Yeah.
So how would somebody easily get into this? Just
right.
just the average person out listening right now, how would they start?
Yeah, I want to give everyone listening to that the confidence that they absolutely can do this. So here's a fun little game I think of. I challenge anyone to go into a local bank and say, I have $100,000. I'd like to borrow another $300,000 to buy stocks. That's exactly what would happen. They'd laugh you out. There's no bank anywhere that would lend you, the average Joe off the street, an extra $300,000 because you have $100,000.
I have $100,000 that I'm not giving you, bank. I'm using that to buy $400,000 for the stock. So you're not getting any of the $100,000.
Yeah. Or even if they would give you, I'll give you the $100,000 if you gave me $300,000, right? It's not going to happen, right? But that transaction happens every single day for every ordinary person in real estate. Yeah. People do that every day. That is how you buy a house. You give them $100,000, they give you, the loan for $300,000, you buy a $400,000 house. Like that is a safe investment because real estate is very stable. It's necessary. People need places to live. So that's the first reason why anybody can do this, right? But back to your question, what are some of the best ways that we can get into this? One is I would highly recommend somebody looking to purchase a home that they don't just think about a single family house. Like they could buy a duplex, right? Where they live in one half, the other half is a rental, right? Yep. That rental actually helps them qualify to buy for this purchase, right? As you know, and that, then you're living and you're building equity and you've got rental income all at the same time, right? So you're buying your primary residence. You could put only 5% down. There's no way you can do that for an investment property, but you can do that if you're going to live there. So you can do this with a duplex or a triplex, maybe even a quad. And this doesn't have to be your forever home. You're being intentional about this. I want to buy rental units at the cheapest, best rates I possibly can. Well, you're going to do that if you're willing to move into it.
Okay, so that's fantastic, and there's a couple things I want to point out on that. First off, like you say, your interest rate is much lower on a primary resident loan than you would get. Your down payment is lower. Your price adjustments are lower. Everything benefits you by doing that. So if you're willing to move into the duplex, the threeplex, the fourplex, and you're willing to move into one of those units for a year, right? You're willing to do that, and depending on your family dynamic, maybe you need the really big unit with 3 bedrooms and everybody else gets the 1-bedroom units, right? Whatever. But by doing that, let's say you only qualify for a $400,000 house. Okay. But all of a sudden I'm looking at a triplex that has 2 units rented, and then I'm gonna go into one. Now I'm qualifying for a $700,000-800,000 property.
Yeah, it increases the qualification potential of the buyer.
Well, and I think it would even increase it to where if you decide to go in and do that, and this is going to sound very elementary, but really think about it. If you're able and willing to move into one unit, you have essentially taken what you said. I'm going to give you my money, and in this case, if you want to get real crazy, you can actually do a down payment assistance, no money down on a 3 or 4plex as well. Like if you want to get real, like way into it, right? But the point being is they're willing to loan you the money.
Yeah.
You move in there, you're there for a year. You've literally bought 4 investment properties, like individual units, 4 individual units that all can generate money, and they leverage against each other. Meaning, if one is vacant, the other 2 are still providing some income. It's not an all or nothing type thing.
Yeah.
And then if one's vacant, you have the chance to rehab, make it nicer, put in some LVP and some paint, and now that's renting for more. And now that increases the possibility for the next ones when those get redone as well. So there's so many ways to do that.
And people also need to understand that when it gets to the point 2 years, 3 years down the road where you don't want to be living in that duplex, triplex anymore, you don't have to refinance an investment loan. Like what you qualified for on day one, your primary residence loan, that just stays. Just stays.
Yeah, no, that's
and that helps to cash flow that.
Yeah, that's massive because now you've moved out of there, and I think the rule is you have to be at least 1 year, right? And then
just 1 year is the requirement.
And let's say you move out year 2, year 3, whatever it is, and you want to go do it again, but maybe a little nicer one this time, right?
Yeah. I love this strategy.
Yeah, a little bit nicer to where you feel like, we've moved up, me and my family, we got an extra kid or 2, whatever it is. Maybe we're going to do a 2plex instead of a 4plex, right? And you still have the primary resident financing on that original one.
Sure you do.
It's absolutely amazing.
Yeah, absolutely. So I call this the move up and rent strategy. It's a very common, name that's thrown around, and it's the cheapest and absolute best way to get your hands on more real estate in the town that you're living in.
Yeah.
So, let's say you did a duplex on the first time around, right? Okay, so 2 years later, you've saved up a 5% down payment for your next house. Because remember, when you're buying a primary residence, we're going to talk about a starter home now.
Yeah.
You're going to go buy a 3-bedroom, 2-bath house, which is a great long-term rental, right? At least that size. It's big enough for a family. People can stay there. So you only need a 5% down payment because you're buying another primary residence. This is not a new investment property, right? All right. And then on the back end where you're leaving, now you've got 2 units that are going to help you qualify for the purchase of the next one. Okay?
Yeah.
Yeah, you need a job. Yes, you need consistent income.
You still need to do the stuff to get a house.
But it's like that helps you qualify for this next house. All right. And a 5% down payment on, let's say, a $400,000 house, that's not ridiculous, right? No. Are we talking $20,000? Yeah.
20 grand. And you've been in this other place for 2 years, 3 years, and you're able to save, you're cash flowing, and your payment's not super crazy because you have 2 other people contributing to that.
So you have that 5% down payment on the next house. You get a primary residence loan, right? You're moving up, all is well for that property. And hey, maybe you're there for 3 years or 5 years, right? And then, as you said, maybe your family grows. Maybe you want to be in a better area of town. Maybe instead of a 3-2, which is still kind of tight for most families, like you want to go to a 5-bedroom, 3-bath house. All right? Well, great. Then you just have to save up the 5% down payment for the third house.
Over the next few years. Yeah, while you're in there.
Yeah, you're only required to spend 1 year there, but you probably need several years to get the down payment. The appreciation can help. And so now, let's say we're on property 3, right? Now we're living in Briargate, right? I don't know where, right? But either way, it's like, we're on property 3. It's probably a long-term great place for my family.
Yeah.
By this point, that duplex that I started buying 10 years earlier, right? Ooh. That's probably ripe for a cash out refinance.
Yeah.
Right? So I can cash out refinance that. The rent, of course, would want to cover the new payment, but maybe I have that $75,000, right? That I now have. All right, what am I going to do with that? Well, we got options, man.
Well, I mean, think about the picture you just painted. You painted a 5 to 10 year plan, or really, let's call it a 10-year plan.
Yeah.
You painted a 10-year plan. Now you own a 2 to 3 unit in the beginning. You own a nice entry-level starter home that's easily rentable on your next year move up.
Yep.
And then you move your family into another place, cash out the 2 to 3plex, go buy another investment. You now have four houses.
Well, you have more than that units.
Because you have units. Because you have like 6-7 units, right?
Yeah.
So when if you're intentional about this, it's completely achievable.
Absolutely.
But you have to be intentional. Most people, like I was saying earlier, the psychology of it, they dive in. It's like things are getting expensive. We better hurry up and buy. Well, what you better do is just slow down when that happens.
Yeah.
Wait until like 2010, not 2006. You know what I mean? When prices kind of come down a little bit, and that's actually kind of where we're at right now in our market. Like it went super high.
Yeah.
And it hasn't really like come down, but it's completely like flatlined.
Yeah.
Right. And I look at it right now as a great time to buy a house.
I do think it's a great time to buy.
Yeah.
I don't necessarily like the discussion of trying to like time the market for buying. Like, I just think you got to be in the game if you want to get a home run every once in a while. And so for those of us who had properties during COVID, instant home run for everybody, right? I looked like a genius, but I didn't do anything, right? I just had properties.
Man, he's so lucky. He's so smart.
I know. I was just in the game.
I was consistent playing the
and
game.
If you think about what we mentioned at the beginning of our talk today is that you and I both bought in 2006, right before the great financial crisis.
Everybody told me it was the absolute worst. It was like within a year, banks are going upside down. I'm like, oh, geez.
But we both still have those properties.
We do.
Right?
Yeah.
They're both worth at least $250,000 more than we bought them for. I mean, it's like, it's okay.
Yeah,
it's gonna be okay.
And here's the crazy part is, like you said earlier, like you can't take the money out of a stock, right? Like you have to sell the whole stock. Well, same thing with a house. My house payment was what it was, even though the value went down. So the house payment was still the same amount.
Yeah.
I mean, it was a little hard to make money during that time period, but you still worked and you made your payments, right? And really where you lost was the selling.
Yeah.
That's where you lost. And had I sold, as it started to climb back up, again, you would have felt like, oh, I made money, but you make more by holding on.
Yeah.
So it's
that's
you
really
gotta
the plan.
You got to have a place to stay. You got to have a place to live. I mean, you could pay rent. That's some people's game plan is just rent forever. But this is an interesting and very achievable way to leverage money. Like if you think about it, if somebody came up to you and they said, Ryan, I want to buy a house and I have no money for a down payment. I want to buy a 3 or 4 unit, and you know that you could still do down payment assistance on that. I mean, and the reason that I'm taking it to that level is it's literally achievable for anybody who has put themselves in a position to buy a house. They could start this path.
Yeah.
Right?
Yeah. It's definitely a choice of most people just think about, the white picket fence, single family,
Little dog running around.
Hey, what if you just delay that by a year or two and greatly change the path of your family's net worth? And, it's just like, it's such a huge over time, the way that this stuff grows, the property values grow. It's just, it could be an awesome thing if you start this the right way.
There was this guy in my neighborhood, an older gentleman that lived next to me. He got sick, had to leave. He had owned the house since it was built in the 60s, right? And I was checking on him, and then I talked to his daughter who said, oh, we sold the house. I'm like, well, what? What do you mean you sold the house? I was just checking to see how he was doing. I was having a hard time. Okay, so we just went ahead and sold the house. I was like, well, who'd you sell it to? They sell it to this guy. He's an investor. And I said, you mind me asking what you sold it for? And I thought it was far below what they could have got for it. So I contacted the investor, and I just said, hey, can I buy that contract from you? I live next door. I just really like, it's just, if you were like 5 blocks away, maybe not, but it's like literally right next door. I've been helping him to take care of his house for a long time. And he's like, no. And so I said, well, I'll give you $20,000 just for the contract. And that's you've had the contract for like 72 hours, dude. Like, it's like really, really fast money. Not interested. So then I see him over next door, and I offered him $50,000 for the contract. Just, that's all you have to do, dude. He's this little dude. And he's like, no, I don't sell properties. I said, what do you mean you don't sell properties, dude? This is like the fastest way you're going to get, like, go buy another one. Like, he's like, no. He's like, I don't sell properties. I'm 14 or 15. He's like, I don't sell properties. It's my family's inheritance, and it's going to help my family forever. Yeah. And I'm like, huh? This dude's playing the long game like no one's business, and needless to say, I don't own the house next to me.
You tried.
I tried.
That was a great one.
I really went after it. But I guess the point being is he understood it better than me and better than a lot of people to be able to go in and do that.
Oh yeah, he bought that house right. You know, he's going to make cash flow and all the other ways that we talked about.
Yep. Yeah. So let's jump into a couple more things. We got a few more minutes here. So how about alternative investments for somebody who maybe, let's say they already own a house or two, and they're like, I don't, my local market I'm not feeling it. What are my other options?
Yeah.
For investing. Let's say I got $50,000. So like, what's my options?
Yeah, you got $50,000. You don't want to move out of your current house, right? When you're really there already, you're comfortable. Your family doesn't want to move.
Correct.
Yeah, and if you don't want to buy locally, then there are multiple really reputable companies that produce what are called turnkey rentals. So, like I bought multiple properties out of state through these types of companies, and what they do is they go into properties or areas, I should say, where the numbers make sense, where you can purchase a house, renovate it, get it rented.
They're just running math.
Yeah, they're running math. You know, it's going to cash flow, and they make the relationships with the rehabbers, with the property managers. They basically get it all set up, and then they get a property. They get it renovated, they get the renter in there, and then they put it on their marketplace to sell it. So as the investor,
rented, rehabbed, everything.
Yeah, it's like done. Like that's why they call it a turnkey rental.
Wow.
So, and it's going to cash flow for you day one. And so, you as the investor, you're buying it for, the long-term benefits and the monthly cash flow, right? But you're not really getting a discount.
Right,
just the purchase part. So that's how the companies make their money. They're typically the realtor on both sides of the transaction. So they make their money, you still get a good cash flowing investment, which, if you're willing to hold it for 5 years or so, you're going to make some great appreciation. And so I've done that multiple times out of state. So that is one pretty simple way where that $50,000 would for sure be enough money.
So with something like that, number one, you're buying an investment property. So you have investment property terms on your loan.
Yep.
Right?
It's an investment loan. It is.
And then, how would you manage? You buy a house in Pennsylvania. How am I going to?
They connect you with great property managers in the area, and it's pretty much like talk to this guy, get set up with these people.
So they just say
it's all professionally managed,
and they just here you go. Here's what you do.
Yep. You got to look at your statement every month, see what cash is coming in, and see what bills there are, and you got to make decisions if repairs are over a set amount, like over $500, right? Then you have to give it a yes or a no. That kind of thing.
Yeah. Have you found that to be worthwhile?
I really have. Yeah. I mean, it's I would say 80% of the transactions out of state that I've done have turned out really well. There is a little bit more risk there, and obviously you have a little less control if it's not in your backyard.
Well, and you got to make sure the company that you're working with. Because if there's a company that you've never heard of and doesn't, you really need to make sure that they have positioned it properly, because if they keep losing for investors, they're going to be out of business.
Right. Yeah, definitely. So as one of the sort of failures that we alluded to earlier, I bought 2 properties in Birmingham, Alabama a while ago, 2020. And the problem with one of them is that the renovation wasn't done great. Right. And so then there was some, water issues and, underneath the house. And it was almost like it was a problem with the renovation. And I don't necessarily blame the company I bought it from, because I bought another property from them too, worked out great. But it was that was one of those things that were kind of, sometimes they show up, right? And you don't totally have control.
Like you say, though, let's say you're winning 80% of the time, you're losing 20, it still works out.
Yeah, I mean, and almost everything is fixable, right? It just costs money to fix it, right? And then you're going to want to hang on to that house to get that money back.
Get the money back out of it. So with that, so these companies, you go in, they say, we bought it, we rehabbed it, we've rented it, and here's the property manager. You're literally now. You're just getting a loan and getting. Are you getting a loan from them, or do you get a loan yourself?
Typically through one of their providers. I mean, they'll have a preferred person. And
so they got their hands in just about everything, but it makes it super easy.
Yeah. They're like, all right, talk to this guy for the loan. All right, talk to this person for the property manager. I mean, you're free to choose your own, but we vetted these people. This is good. And they just hold your hand through the whole thing and step by step, and then you've got a rental property. Wow. And it's really a great way to get started. If you want to be more passive, if you don't really want to learn the business.
With that would bring up two questions. Number one, what would be the normal down payment? Are you doing like 10%, 15%, 20%?
Yeah, they're usually about 20%. I think all the ones I've done out of state were 20% down.
Okay, so if you have 20% down, the next part of that though, like 20% down's a lot different buying a house in San Francisco than Birmingham, Alabama.
Oh
right?
yeah,
like 20% down is a huge difference. So are these targeting house prices that are lower than your normal community house prices? Meaning, like are they $100,000 cheaper houses, $200,000 cheaper houses?
Mm-hmm. Yeah, I mean, they're looking for working class, rentals that can be affordable to the people renting them. So, yeah, specifically these houses in Birmingham, Alabama that I got in 2020-ish, somewhere right around there. One was 90,000. That's a little smaller house.
Okay, yeah.
And one was like 120,000. But they're like houses for that amount, right?
That's a lot cheaper than.
Yeah. I mean, even in 2020, like that was before the run up of prices.
That's
but
true,
still, I mean, it's still a lot cheaper than if we're talking about a house in an area of Colorado. But there's a reason why our houses are more expensive here, right?
Yeah.
We have way better appreciation, right?
Yeah.
Long-term growth.
Yeah.
So I guess that brings up the point of if you're investing, kind of know why you're investing. If you're investing for long-term growth, net worth, sort of legacy wealth type of thing, you probably want to invest in Colorado or a great city like Colorado Springs.
Yeah.
It's stable, and we have such a stable real estate market compared to many other places.
Yeah.
You're not going to cash flow as much, but the places in, let's say, Birmingham, Alabama, the cash flow is better for the money that you invest. But that house isn't going to go up in value like a house here will.
Right. Okay, interesting.
So it's like
when we look at our 5 items, the cash flow, appreciation, depreciation, amortization, and time value money, when we look at those 5, basically, depending where you're investing, the scale's tipping. So
that's exactly
cash
right.
Flow,
Yeah.
appreciation, better depreciation. So it's kind of overall you still have to, your alchemy still has to be there, right? Like the potent still has to be there, but it could be different levels of each.
Yeah. Kind of know what your target is, know what your goal is.
You mentioned the word syndication to me earlier. What is syndication?
So a syndication is like the ultimate hands-off investment.
Okay.
But you got to realize you're betting on the jockey, all right? So it's like, before a syndication is an investment where it's typically for people who are accredited investors.
Okay.
So accredited, I mean, that's a sort of a tax rules as far as who is. It's not for everybody.
It's a certain net worth or something.
Yeah. Most people don't realize like the federal government actually limits the investments of what you can and cannot do. You can't just invest in anything you want, right? I mean, you have to show that you have a certain amount of sophistication, or in this case, accreditation, to invest in certain deals. I mean, if you want to call them like they're the country club deals, all right, so an experienced syndicator is going to buy an apartment complex that has 200 units. Yeah. And, they're raising money to do the down payment.
Okay.
All right. And then, there's a certain business plan, for this purchase. It could be to renovate these units, increase the cash flow, and then, of course, that increases the value of the property.
They have their investor plan on what to do with
and
the
so
property.
they're selling that to you as one of the, limited partner investors. So the good thing about these things is like once you put the money in, you're just watching it. Right. You're like, it doesn't take any time. I mean, they'll give you updates, but like you literally have no control.
Yeah.
But, if they're done well, you could say probably my money will double in about 5 years.
Okay.
It's about average for good ones.
So when you do a syndication 200 unit apartment, are you talking like 50 different people are investing in this, 10 different people?
At least. No.
Okay.
It's probably, sometimes it's in the hundreds.
Okay.
So yeah, I mean, it's, if a company who does this frequently and has multiple different apartment complexes under management, they raise the money with investors, and so a buy-in could be $50,000.
Gotcha.
Some of them even go beginning is $100,000.
Okay,
and so commercial real estate's a whole different game, right? So I mean, I've got my scars with that too. It's and
Yeah.
You got to understand whether it's with fixed financing, right, which we're used to in the single family market,
Yeah.
right? 30-year fixed. Yeah, not so much in
Or
commercial.
if it's adjustable and blue.
Yeah, yeah.
5
It's
years.
like, yeah. And the Federal Reserve triples rates in,
Yeah.
a period of a year. It's like stuff like that.
Yeah, but this is the good thing about this. These are all interesting ways for you to invest in real estate.
Yeah. Many avenues.
And whether it's in your own backyard and you have total control, whether it's out of state and it's a turnkey,
Yep.
whether it's a fractional ownership of a large investment.
Yeah.
There's a lot of areas to go and still get the benefit of these 5 items.
Yeah.
Right?
Yeah. There's so many options.
So what else do you want to throw out there for us?
So I want to talk specifically to real estate agents
Okay.
and other real estate professionals,
Okay.
why every person who has that title should highly consider investing in real estate.
A licensed realtor.
Yeah, but it's not
Okay.
just like, a real estate professional is a sort of tax label, right?
Okay.
So like even some investors, full-time investors, right?
Yeah.
Or
We go as far as to
yeah,
say
it could be like
inspectors,
title, it
stuff
could be
like that?
inspector.
Okay.
Yeah.
So you're a real
It's-
estate professional.
Yeah.
Okay.
So, there's multiple reasons why to purchase real estate. But first, you kind of have the insider knowledge. You're on the MLS all the time. You know what properties are worth.
You're
probably
seeing
the
this stuff every day. You
yeah.
got a good
You're
pulse
probably
the
one of the
market.
first people to see certain
Yeah.
properties that can come up, and especially if they're at a discount, right?
Yeah.
That's benefit right there. Secondly, your compensation that you get typically in the purchase, that can be applied. And in some ways I don't totally understand, but could be applied as your portion, like maybe towards your
contribution
towards your down payment or your closing costs,
yeah.
and or just making the property cheaper for you to buy
You're
because you're a
gonna
realtor.
take off $15,000 and I'm not going to take any commission.
Yeah.
And you're buying it cheaper.
Yeah.
Yeah.
So it's like the seller net's the same, but you're getting a better deal,
Yep.
right? So, and then the last thing is, as a real estate professional, any depreciation, remember how we talked about that
Yeah.
phantom loss, that can be applied off of your earned income. So let's say you've got closings, right? And you've got $150,000 in compensation that you earned that year.
Okay.
All right. And you have $100,000 of depreciation write-offs from properties and other real estate investments. That means you're only paying taxes on $50,000 of your earned income. Okay.
Wow.
Nobody
Yeah.
else can do that. Like the way the taxes work is that pretty much passive investments, write-offs on that can only write off income from other passive investments.
Okay.
Right. And then you've got earned income.
Really tight guardrails on the other.
That's the way the tax system is set up.
Okay.
But those guardrails are gone for people who are real estate professionals.
Wow.
So like if you, especially things like these syndication investments, sometimes can have major write-offs. So like, from one investment, I remember one year I got a $75,000 depreciation. It was a K1, and boy, I didn't have to pay taxes on $75,000 of my income. It was a good day.
Well,
It was like stuff like that can happen,
do that
right?
again, yeah.
That's
Yeah.
why every single real estate.
And the interesting thing about that is we want to be really clear. This is not the cost of a water heater. This is depreciation.
Yeah.
This is depreciating different areas of the investment.
Yeah.
Right?
Yeah.
So like we say, phantom losses, it's not a real cash loss.
Right. That was a paper loss. That was a tax savings is what that was. I wouldn't want to call it a loss at all.
That was a gain.
That was a gain.
Do that again. So, I mean, looking at this, we went through and we hit a few very critical things. We talked about why we compared versus stock markets. We talked about easy ways to invest locally, how to do it nationally, how to syndicate it, why everybody should do it. This is gold. Everybody should listen to this and probably go buy an investment property.
Go do it.
Call 719 Living for your financing.
That's right.
Well, Ryan, thank you very much for being here.
You're very
I really
welcome.
appreciate it. And guys, that wraps up another episode of AgentSuccessPodcast.com. Here with your guest, Ryan Jahnke. I'm your host, Tim Chase. You can reach us at 719-888-5253. At least, okay.
It's probably, sometimes it's in the hundreds.
Okay.
So yeah, I mean, if a company who does this frequently and has multiple different apartment complexes under management. They raise the money with investors, and so a buy-in could be $50,000. Some of them even go beginning is $100,000. Okay, and so commercial real estate's a whole different game, right? So I mean, I've got my scars with that too. It's and you got to understand whether it's with fixed financing, right, which we're used to in the single family market, right? 30-year fixed, not so much in commercial.
Or if it's adjustable and balloons in 5 years.
It's like, the Federal Reserve triples rates in a period of a year. It's like stuff like that.
Yeah. So but this is the good thing about this. These are all interesting ways for you to invest in real estate.
Yeah. Many avenues.
And whether it's in your own backyard and you have total control, whether it's out of state and it's a turnkey.
Yep.
Whether it's a fractional ownership of a large investment.
Yeah.
There's a lot of areas to go and still get the benefit of these 5 items.
Yeah.
Right?
Yeah. There's so many options.
So what else do you want to throw out there for us?
So I want to talk specifically to real estate agents and other real estate professionals, why every person who has that title should highly consider investing in real estate.
A licensed realtor.
Yeah, but it's not just like, a real estate professional is a sort of tax label, right? Okay. So like even some investors, full-time investors, right? Or
we go as far as to say
it could be like title, it could be inspector. Yeah.
So you're a real estate professional.
Yeah. Okay. So there's multiple reasons why to purchase real estate. But first, you kind of have the insider knowledge. You're on the MLS all the time. You know what properties are worth. You're
probably seeing this stuff every day. You got a good
You're
pulse
probably
on the
one of the
market.
first people to see, certain properties that can come up, and especially if they're at a discount, right? That's benefit right there. Secondly, your compensation that you get typically in the purchase, that can be applied. And in some ways I don't totally understand, but could be applied as your portion, like maybe towards your contribution, towards your down payment or your closing costs, and or just making the property cheaper for you to buy. Because you're a realtor.
You're gonna take off $15,000 and I'm not gonna take any commission. And you're buying it cheaper.
Yeah. So it's like the seller net's the same, but you're getting a better deal. Right. So, and then the last thing is, as a real estate professional, any depreciation, remember how we talked about that phantom loss, that can be applied off of your earned income. So let's say you've got closings, right? And you've got $150,000 in compensation that you earned that year. Okay. All right. And you have $100,000 of depreciation write-offs from properties and other real estate investments. That means you're only paying taxes on $50,000 of your earned income. Okay. Wow. Nobody else can do that. Like the way the taxes work is that pretty much passive investments, write-offs on that can only write off income from other passive investments. Okay, right? And then you've got earned income.
Really tight guardrails on the other.
That's the way the tax system is set up. Okay, but those guardrails are gone for people who are real estate professionals. Wow. So like if you, especially things like these syndication investments, sometimes you have major write-offs. So like, from one investment, I remember one year I got a $75,000 depreciation. It was a K1. Yeah. And boy, I didn't have to pay taxes on $75,000 of my income. It was a good day. Well, it was like stuff like that can happen.
Let's do that
right?
again. Yeah.
That's why every single real estate.
And the interesting thing about that is we want to be really clear. This is not the cost of a water heater. This is depreciation. This is depreciating different areas of the investment, right? Yeah. So like we say, phantom losses, it's not a real cash loss.
Right. That was a paper loss. That was a tax savings is what that was. I wouldn't want to call it a loss at all.
That was a gain.
That was a gain.
Do that again. So, I mean, looking at this, we went through and we hit a few very critical things. We talked about why. We compared versus stock markets. We talked about easy ways to invest locally, how to do it nationally, how to syndicate it, why everybody should do it. This is gold. Everybody should listen to this and probably go buy an investment property.
Go do it.
Call 719 Living for your financing.
That's right.
Well, Ryan, thank you very much for being here.
You're very welcome.
I really appreciate it. And guys, that wraps up another episode of AgentSuccessPodcast.com. here with your guest, Ryan Jahnke. I'm your host, Tim Chase. You can reach us at 719-888-5253.
That wraps up another episode of Agent Success Podcast. Remember, you can find new episodes each week at agentsuccesspodcast.com. We hope you found the insights and best practices shared today truly valuable. And if you did, please subscribe, rate, and leave a review on your favorite podcast platform. Remember, your success is a journey of learning and improvement. So let's keep hustling, thriving, and learning. Until next week, this is Tim Chase.